Guys, what's going on with Intel? Their stock price is soaring. Meanwhile, their 33 billion euro investment is at risk. What's going on? And should we be buying? Well, let's find out. So here's the story. Intel have plans for investments in Europe, and this initial investment plan consists of more than 33 billion euro for semiconductor research and development and manufacturing throughout Europe. The plan is to build a leading-edge semiconductor fab mega site in Germany to establish a new research and development and design hub in France and to expand capacities in research and development, manufacturing, foundry services, and back-end production in Ireland, Italy, Poland, and Spain. And with this landmark investment, Intel will bring its most advanced technology to the continent, helping the EU create a next-generation European chip ecosystem and address the global need for a more balanced and resilient supply chain, which will result in meeting the surging demand for advanced semiconductor. All this is great news, but why is it at risk? We'll explore that later, but let's first get to know the business of Intel. Intel Corporation is a global technology company specializing in design, development, manufacturing, and sales of computing and related products, operating through various segments including client computing, data centers, and AI, network and edge, mobile, accelerated computing system and graphics, Intel Foundry Services, and others. The company offers a range of platform products, connectivity solutions, and memory storage products. It provides high-performance computing solutions for vertical markets like retail, industrial, and healthcare, as well as solutions for assisted and autonomous driving. Additionally, Intel offers workload-optimized platform for cloud service providers, enterprises, government, and communication service providers. The company incorporated in 1968 and are headquartered in Santa Clara, California. Now, let's look at the numbers. We can see here is that Intel is traded on NASDAQ and are in the technology sector and have a market capitalization of $160 billion. Their revenue coming in at $63 billion. If we take a closer look here, we can see that the revenue went from $72 billion and grew to $79 billion before dropping down to $63 billion, dropped with 20% in 2022. But that is too early to say that this is a change of direction. We need to continue to keep an eye on the business and see how this develops. Looking at the profit margin coming in at 42%, if we look at the annual reported profit margin, we can see it went from 29% down to 25% before dropping 49% in 2022 down to 12.7% profit margin. So this is quite alarming, seeing that the revenue is dropped and the profit margin has been declining over the years. Looking at the price to sales ratio and price to book value, depending on who you are as an investor, some may see this as the company being overvalued. Now, they cut the dividends, and if we look at historical data, we can see that the dividends have been increasing over the years. It went from $1.26 up to $1.46, and we can see that the annual growth of the dividends have been around 5% annually, which is great. Looking at the return on equity and return on assets, we see here the return on equity have been dropping over the years, and this tells us about their ability to create return on the equity shareholders invest in the business, and seeing that these numbers is dropping, that is not good at all. If we look at the return on assets, which basically tells us about how effective the business utilizes their assets in order to create profits, we can see that these numbers have been dropping as well over the years, and that is negative. I don't like that at all. So the stock price is currently traded at $43 per share. If we look at the chart, we can see it have been moving within the positive trend channel for quite some time, but have of lately broke out of that channel and now moving toward the $43 share. But what is careful to watch, what I'll be watching is to see how the stock price develops. Will it fall down towards the support line here, and will there be a lot of buying that occurs at that level? And what me personally would do, I would still be waiting to see if the stock breaks above this area. Then that might be in buying opportunities. But one thing to consider though is is the fundamentals actually supporting the stock increase? Because what we saw, as I mentioned, is that there are 33 billion euro investments at risk. So let's look at the fundamentals. And now, what I like about this page is that it gives me a glimpse of the business performance without digging too deep into the business. But let's go over to the income statement. As we saw previously, is that the revenue had been growing from 72 up to 79 before dropping 20% to $63 billion. But let's look at the net income. We can see here the net income have been decreasing over the years. And we can see here a huge drop in 2022 with 60% from 19 billion down to $8 billion. So this is very alarming. Let's see the basic shares outstanding. We can see that the basic shares outstanding have been dropping. Basically, they're doing the buyback programs. Me personally, I would like to see them actually halt or pause the buyback program, because I'm seeing alarming numbers. The return on equity is dropping, return on assets is dropping. The revenue just dropped in 2022, and the net income is dropping. So for me, I would love to see that they pause the buyback programs. I also think it's positive that they have cut the dividends in order to structure the capital in the business. But let's head over to the balance sheet. And what I'm interested in here is to look at the current assets and compare that to the current liabilities. We can see here that the current assets have been increasing over the years, and in 2022 came in at $50.4 billion. If we look at the total current liabilities, we can see here they have been growing over the years, and in 2022 came in at $32 billion. So there is a huge difference between the current assets and the current liabilities. Basically, if they were to convert their current assets to cash, they're able to pay off their current liabilities and still have like the 20 billion left on the table, which is great. And looking at the total liabilities, they are far from being able to pay off the total liabilities, and we can see that they have been growing over the years. But what thing though that is positive that I see right away is that the growth which the debt has been growing is actually diminishing. It's decreasing. So that is a plus. I like that. Now, let's head over to the cash flow. And while I'm looking here at the operating cash flow to see how the cash generated by their core business have been going over the years, and we can see here it have been increased 1 year, but have since been dropping year over year. So this is negative. And their investment activities, investing cash flow, also been dropping over the year. They recovered a bit in 2022 here with 60%, but overall it's negative. But at the same time, as I mentioned, as we saw earlier, is that it is too early to say whether this is a change of direction. Now let's look at the financing activities, the free cash flow. And we can see that these numbers, it grew 1 year here between 2019 and 2020, but I have since seen lower numbers, so that is negative. But let's take a look at the capital expenditure. Okay, so they continue to invest in their business, so that is a plus. Because they need to find new opportunities, new ways to make profits. So I like that they continue to invest in the business. Great. Now let's look at the KPIs. We can see here right away is that the earnings per share have been dropping, the revenue per share have been dropping, equity per share have been more stable though, and a small increase between 2018 and 2022, but overall trend is positive, so that is great. When they used to pay dividends, historically we saw it went from $1.26 up to $1.46, and an increase annually of 5%, which is great. Looking at the dividend payout share, it was ranging between 26 and 28%. That is, I think, is great, because for me personally, I like companies that keep some of the capital in the business for investments, acquisitions, or just overall strengthening their finance. And if we look at profitability, first off, gross margin, we can see right away that it comes in at 42%. It is hard to say whether these numbers are good, because we need to compare this across the industry and see how Intel is doing compared to the competitors. But we can also see right away that these numbers have been dropping year over year. So that is negative. What is happening here is that the cost of goods sold is increasing. So Intel needs to find ways to become more efficient And looking at the operating margin, we can see right away that these numbers have also been dropping year over year. So Intel needs to become more efficient and also find ways to cut cost, because we see here profit margin have been dropping year over year. So that is negative. Return on equity and return on asset, as we looked before, it is also dropping. So Intel needs to work on the profitability. This is not good at all. Looking at the financial strength, solidity, the financial strength for the long term, we can see here a bit of fluctuation. It fell a couple of years. It fell a couple of years before it recovered. And we can see it's not a huge difference between 2018 and 2022. A bit of decline, but overall trend, I do like what is going on here, that they managed to maintain good solidity. Balance sheet liquidity tells us about financial strength for the short term. And we can see here, these numbers have been increasing over the years. So that is a plus. I do like the fact that financial strength is looking much better. By looking at the debt ratio, we can see it has been growing over the years, went from 0.5, 0.7, 0. So these numbers have been increasing over the years. So that is negative. Basically, in 2022, they had 0.7 times more debt than equity. I see that these numbers is increasing. That is negative. Working capital, too much of a fluctuation. I would love to see a more stable development. So this is negative. But the capital turnover, this is actually very positive. So this one I do like. So a lot of challenges ahead, a bit alarming, many alarming areas that I see that they need to improve. So guys, we have gone through the stock overview, the income statement, balance sheet, cash flow, the key figures. Now let's look at our key feature, which is the stock analysis. What it does is that it gives you a simplified, holistic overview of the company's performance, saving our users so much time, because in just a quick glance, you get a overview of the company's performance. We can, for instance, see in this based on this profile that the PE ratio is below 20, and the price to sales ratio and price to book value coming in a bit too high, making the stock overvalued. They don't pay out any dividends, and the dividend payout share latest was over 70%, which is negative. And the dividends have increased for the past 5 years, and the number of outstanding shares have decreased. Looking at the financial strength, we see that the current assets is greater than the current liabilities, but not greater than total liabilities. Solidity have increased over the years, fell off a bit if we compare 2022 numbers with 2018, and balance sheet liquidity have improved. The debt equity ratio have increased, and the total liabilities also have increased. In a simplified way, we can see right away what the company needs to work on. And the same thing if we look at the profitability. And based on this profile, the Intel gets a FINV score of 15, which is classified as weak. And looking at the price development, the stock price is currently overvalued, and the price development indicate that we might see increase of the stock price. So as you can tell, it gives you a simplified, holistic overview of the company's performance. And if you want to see, is Intel the best performing stock for me in this industry? It is easy to find out. Just click on the tab industry, and you can see here that Intel comes in at position 30. So you have a lot more companies that are doing better than Intel. Now, I mentioned earlier about Intel's 33 billion euro investment being at risk. Well, earlier this year, Intel disclosed an investment of over 30 billion euros in Germany to expand its European manufacturing capacity. The facility will likely create 7,000 construction jobs over its first phase, with a projected about 3,000 permanent high-tech jobs at Intel and tens of thousands of jobs across the industry. In December, Intel reportedly halted its chip factory construction in Germany because it was seeking more public subsidies. And the reason is surging energy and raw material, which have disturbed Intel's initial calculation. They had initially budgeted for a cost of 17 billion euros, and prices are now closer to 20 billion euros. And Intel have stated that geopolitical challenges have grown and demand for semiconductors have fallen. And Intel is now in discussion with the German government regarding bridging the funding gap. Now, with all this in the air, the stock price increasing, but the fundamentals not really being in there, is it really time to buy the stock? What do you think? Please let me know in the comment sections below. And that's it for this episode. I hope you have enjoyed this one. And please give us a thumbs up, comment, subscribe. And if you have any stocks you want us to take a look at, please let us know in the comment sections below. Until next time, guys, take care. Bye-bye.